Let's pause and reconsider what's really unfolding here, because nearly everyone tracking the news is getting it wrong. This isn't truly about Venezuela. It's not even centered on Maduro himself. What occurred recently was a catalyst, a flashpoint that ignited a far bigger system already strained to its limits. When the United States intensified its actions against Maduro and clamped down on Venezuelan waters, it wasn't merely upholding sanctions or setting an example for a disliked government. It was targeting a vital pipeline, oil. In global strategy, oil never stays regional. Disrupt one source and the ripple effects spread through supply lines, markets, and partnerships. This time, the impact didn't end in Caracas. It reached all the way to Beijing. For years, Venezuela has served as a low-cost oil provider to China. A subtle yet essential element in Beijing's plan for energy independence. By ramping up pressure on Maduro, Washington didn't just hit a regime it views as adversarial. It interrupted a supply line China relies on, turning a local issue into a worldwide standoff. Mainstream stories focus on corruption, cartels, or political instability, but those are superficial. The deeper pattern is clearer. When the U.S. seeks advantage, it avoids direct military force. It targets bottlenecks, sea routes, insurance rules, port entry, inspections, and naval patrols. Dominate energy transport, and you dictate the pace of whole economies. The Venezuela operation follows this playbook exactly. By creating doubt around exports, the U.S. turned uncertainty into a weapon. Tankers pause. Insurance costs soar. Buyers retreat. Even compliant vessels steer clear as delays eat into profits. For massive oil carriers, lost time means massive expenses that snowball fast. That's the nature of today's economic pressure, silent, bureaucratic, and incredibly potent. Yet most analysts miss the key error. They think this was solely aimed at Venezuela. It wasn't. Venezuela is just the tool. The true focus is far away, in refineries processing that discounted oil and feeding it into a vast industrial network. China has long fortified its energy approach, varying sources, securing deals, and capitalizing on global tensions for affordable supplies. Discounted, isolated Venezuelan crude fit perfectly. When that supply is jeopardized, Beijing doesn't view it as a minor dispute. It sees a threat to its energy safety, and for an industrial giant, that's equivalent to national survival. That's why China's response was unavoidable. As shipments slow, output drops, and storage overflows, the fallout spreads. Chinese processors feel it right away. Slimmer profits, higher costs. Long-term plans falter. Beijing must then reevaluate not only its energy risks, but the entire way America wields influence worldwide. Here the conflict evolves. America boasts superior naval power and unmatched sanction enforcement over oceans. China recognizes this and knows matching it directly would be costly, lengthy, and provocative. So it chooses imbalance, ways to inflict pain without direct clash. This is what makes the moment pivotal. The Venezuela move didn't just restrict flows, it revealed a weakness, reminding Beijing that real-world supply lines remain exposed to U.S. dominance. Once that sinks in, the counter doesn't come via statements or diplomacy. It arrives through money, currencies, and markets. America rules many ocean paths, but China has built its own currency and finance as a rival force. This isn't speculation, it's unfolding strategy. And what we're seeing is the start of a wider realignment, where Beijing indicates, squeeze our real supplies, and we'll hit back where you're vulnerable. Markets, investments, and the dollar. That's why it seems abrupt to outsiders, like a standalone event, but it's actually built up pressure releasing after years. America activated the oil mechanism, expecting limited fallout. China saw it as a direct challenge to its economy, and that view makes the reply foreseeable. Quiet, understated, but fundamental. It's not a standard trade fight. It's a reshaping of influence, with money as the tool and markets as the arena. This is the point where a local crackdown becomes the first step in a currency conflict, and crossing that line offers no simple retreat. After the initial jolt, things didn't descend into disorder. Instead, a calculated constriction of Venezuelan oil turned the area into a financial no-go zone rapidly. Once America indicated close monitoring of those waters, global shipping rules engaged. Few notice this. Oil doesn't flow just because it's there. It flows thanks to insured risks, reliable ports, steady timetables, and tolerable weights. Disrupt one support, and the chain strains. Disrupt more, and it breaks. Through checks, seizure hints, and ongoing Navy visibility, the U.S. didn't have to stop every ship. Just enough doubt made involvement unprofitable. Shipping runs on slim profits and rigid schedules. One delayed day for a huge tanker costs tens of thousands. Extend that to weeks of checks or detours, and it no longer adds up. The outcome enforces itself. Vessels divert early. Deals get scrapped preemptively. Coverage gets pricier or vanishes. A formal blockade becomes a widespread avoidance. Modern control thrives on motivation and caution, not constant action. As this built, Venezuela felt it fast. Output plunged, not from dry wells, but full storage. Stalled exports fill tanks. Full tanks force slowdowns. No workaround exists in a neglected infrastructure. Targeting outflows over sources maximizes impact with little direct involvement. But the effects soon escaped Venezuela. Each undelivered barrel meant one missing elsewhere. And for China, that gap outweighed any news coverage. Chinese plants plan around steady, cheap inputs with tight margins. Sanction hit, Venezuelan oil was key. And when deliveries halted, it disrupted budgets, projections, and security math. Here, America's intent shows larger. Not just penalizing a government, but proving it can interfere in global chains anytime. The signal? Seaborne oil travels with U.S. approval. Beijing heard it loud and clear. Short-term wins aside, this invites adaptation and cost. China views it as a flaw to fix, not by naval rivalry, but by lessening dependence on the enabling system. Thus, it quickly moves past oil. Energy sparks it. Finance answers. In the meantime, markets adjust risk. Reduced supply raises volatility. Prices respond to perceived weakness, not just real gaps. Geopolitical add-ons enter trading. This affects inflation outlooks, rates, and sentiment everywhere. A Latin American move now sways distant assets. Enforcement grows trickier, too. Hidden fleets appear, flags switch, ownership hides in layers. Vessels evade via loopholes, raising error risks, wrong stops, incidents, third-party tensions. It turns into tense ocean pursuit. Meanwhile, costs climb. More Navy spending, wider deficits, clearer global policing price. Beijing notes, America can do this, but expensively. Each operation strains budgets already burdened. Deficits mean higher rates, debt costs, foreign funding needs. Here, the reversal. Physical control exposes financial weak spots. That's China's long-awaited gap. While America eyes vessels and rules, China readies in less protected areas. Finance needs trust and involvement. It shifts quicker than fleets. Venezuelan constriction is thus a crack in a bigger framework. China recalibrates. Geopolitical cheap oil can be cut by geopolitics. Priority, cut risks, push back, change arenas. The fight leaves seas for ledgers. The squeeze works, but hastens a financial stage. Levers monetary, affects market-wide. An energy pinch becomes prelude to deeper instability, involving all investors and banks unwillingly. The shift happens as local pressure collides with a superpower. America calls it regime enforcement. Beijing sees deliberate choke on its industry fuel. Misjudgment here. Venezuela matters little economically to U.S., hugely operationally to China. Chinese buyers took risks others avoided, securing bargains for planning. Pragmatic, not political, affordable energy, fuels, manufacturing. Disruption loses barrels, leverage, margins, options, and sets precedent. Throttle one today, others tomorrow. This reshapes China's calculations. Danger in asymmetry. U.S. squeezes cheaply domestically. China can't ignore input threats. It invites escalation, low-cost opportunity for one, intolerable risk for the other. Local actions balloon systemically. Stopped oil exposes dependencies. Sharp Venezuelan drops forced instant Chinese shifts. Alternatives aren't instant. Contracts, logistics, crude types matter. Heavy Venezuelan oil suits specific refineries. Lighter swaps cut efficiency. Systems build over years. Disruption cascades costs. Beijing sees an unlegislated energy levy on itself. Error. Linking rules so closely to flows pulled China in. Once in, containment fails. Cartel or sanction tails fade. The action crossed a hidden boundary, turning bilateral to global chain test. China answers systematically. Diagnose vulnerability. U.S.-influenced routes. Mitigate. Stockpiles. Short-term diversification costly. Counter. Hit exposures. This fuels next stage. America sees rule-keeping, Beijing, future warning. Sensitive regions flows weaponizable. For massive importer, existential. Response moves to trade system. Can't match ocean control fast, but can mold market incentives. Shift flows, policy, dollar appeal marginally. Cumulative, hard to stop. America stays on visible. Diverted ships, falling output. Underestimates signal effect. Easy disruption drives dollar system escape. Insulation accelerates now. China faces truth. Vulnerable suppliers, risky, but rival-policed system riskier. Conflict turns structural. No longer single tanker. Can China accept Washington-throttled industry? No, so prevent future via finance. America blocks ships, but can't force dollar hold if options grow. Pushing oil highlights own fragility. Power costly, debt tied. China sees. Deployments strain rival fiscally. Openings form. Not linear. Maduro pressure. Oil, China, U.S. markets. Predictable and intertwined energy finance power. Error assuming Venezuela containment. Can't. Major economy. Targeted core. Responds in strength. Monetary. Scene sets for shift to rates, flows, anchor contest. Oil sparked, currency blazes. Widening reveals geography. Oil moves via choke points. China's routes narrow, controllable. One region tightens, global signal. Access conditional. permanent insecurity for importers. China feels deepest. Manufacturing exports. Stability needs steady materials. Indirect disruption forces rethink rise structure. No longer Venezuela. Maneuvers are trials. Testing limits, reactions, adaptations. Unsettling confirmation. Chains vulnerable beyond deals. Even diversified, route dominance persists. Demonstrated live. Presence costs rise. Debt financed. Trade-off. Global projection expensive. China benefits without matching. Costs accumulate. Logistics weapon weakens wielder financially. Exploitable asymmetry. America invests seas. China positions for fallout. Buildup admits. Order costly. Warning and chance for China. Military feeds deficits. Borrowing. Market dependence. Battlefield financial. More force. More exposure. China prepares quietly. Blockade urges de-risking alternatives. Route talks lead currency. Can't secure all points, but multipolar finance dilutes enforcement. Erode dollar monopoly marginally. Shifts reduce sanction bite. America knows theoretically, but actions hasten. Naval sanction lean incentivizes escape. Venezuela example. Pressure reminder, physical costly. China adjusts via cues. Investors note, expectations change. Process hard reverse. System sensitive stability. Confidence waiver ripples. Irony, strength demo weakens base. Dilemma, physical versus sustainable. Leverage short versus confidence long. Prize not oil. Trusted system under stress. Contest nears tip. Not seas decide, but rules, reserves, currencies. Next subtle, Beijing uses expectation tool. Currency, strategic message. No declaration. Shows tolerance, shifts. Managed weak for exports long. Context changed. Access threat, prioritizes resilience, attraction. Stronger UN signals, sacrifice exports for gains. Pressures US via flows. Chinese assets draw amid dollar burdens. Capital seeks yield stability. Blunts manipulation claims, market-led. Weakens tariff case. Boosts asset buys, commodities cheaper. Currencies hold trust. Dollar pressure seeks alternatives. US dilemma, presence borrows, supplies debt, needs yields, strains, persistent dollar drag. China needs marginal. Reserve shifts, non-dollar trade, bond interest, chips insulation. Disruption reminds risk core. Alternative, diversified stability. Understated power, no drama, cues tell story, comfort strong currency. Markets heed credibility, consistency. Firming draws flows, improves performance, loop. Steady flywheel, US harder counterconfidence. Blunt tools, severe effects. Patience favors China. Gradual strengthen, absorb adjustments, gain inflows. US balance is immediate. Episode accelerates pivot export to leverage. Structural response, long contest balance sheets. Essence emerging war, yields, expectations. Portfolios quiet, more consequential. Reroute ships easy, shift capital momentum hard. Door opened. Calculation step through. Cost clearer. Battle perception. Small signals big. Ripples reconnect. Reprice decades assumptions. Higher yields stress signal. Paradox. Attract needs higher. Burdens more. Exploits. Choice. Debt system or stable intent. Marginal matter. Intersect economy. Cheaper imports. Power abroad. Gold focus. Statement autonomy. Disciplined organic. Framing reduces resistance. Reinforces narrative. Beyond. Settlement evolve. Risk reduce alternatives. Cumulative exclusivity down. Feared. Leverage undermine. Options multiply. Potency down. Tools accelerate alternatives. Illustrates control revealed dependence. Not break. Rebalance. Multipolar. Risky opportunistic. Transition precision need. US decide double or adapt shared. China prepared long. Wars, persistence, trust. Less retaliation. Positioning. Catalyst oil. Contest finance rules. Uneven effects. Direction clear. Weapons push, domain perception confidence. Agility, patience key. Advantages costly. Exploit without provoke. Background reshape. Cumulative reshape irreversible. Conclusion, structural shift power. Move exposed, not created. Forces converging years. Lines visible. Control demo, cost demo. Response recalibration. Misses point simple retaliation. Adjust assumed access. Deliberate insulation. Currency effective continuous reshape. Challenge, manage all domains costs. Consequences feedback. Not finished, margin shrink. Alternatives viable, bite less. Deep understand gradual erosion. Less single anchor, unilateral vulnerable. Shock forced postponed choices. Watching questions, assumptions, diversification, risks. Behavior scale shift systems. Phase accumulation subtle. Add up. Irony consequential quiet. Measured basis points. Confidence. Trigger Venezuela. Implications beyond. Power adapts expensive contested. No sole force without price. Early recognize advantage. New phase volatility narratives. Beneath direction clear. Unquestioned to contested. Important decisions, quietest. Oil squeeze reckoning influence. Once starts, reshapes years.